Hello and welcome back to another video lecture of Financial Derivative and Risk Management. You are watching our YouTube channel Even College Digital Classes and virtual platform of Udayanath Autonomous College of Science and Technology situated in the district of Cuttack at Adaspur. So, we are discussing the option contract of financial derivative, and in that we know the basics and preliminary things of option. We also discussed about the types of option and what are the things that are there involved in option contracts. We come to know that option is the financial derivative which are mostly opted by the high risk opting investors, and this option contract gives the holder the right but not the obligation to execute the contract. That means the holder can hold the contract by giving the minimum charges that is known as the premium, and they are holding the contract, but at the time of expiration or at the expiration date, it is not mandatory to execute that. According to the situation, they can hold the contract or they can execute the contract as per the terms. So, this is what option contract is, and it is a very interesting thing to know about this option contract. And in that we know that there are types of option contracts. It might be a call option or it might be a put option. Call option gives the buyer the right but not the obligation to buy the contract, to buy the underlying asset, and the put option gives the buyer the right but not the obligation to sell the contract. That is what the interesting fact of this option contract is. In today's class, we are going to read further and go in deep into this option contract and know some more facts about it. In today's class, we are going to discuss the pricing of this option contract. So, without much delay, let us start our today's class, that is pricing of option. So, this option pricing theory estimates a value of an options contract by assigning a price known as a premium, what we have already discussed, and that is based on the calculated probability that the contract will finish in the money at expiration. And the essentially option pricing theory provides an evaluation of an option's fair value which traders incorporate into their strategies. And the greater the chances that the option will finish in the money that will be profitable, the greater the value of the option, and just the vice versa when the situation is adverse. So, some commonly used models that are used to price these options, that includes the Black-Scholes model, binomial tree, and Monte Carlo simulation method. So, these are the models or these are the theories that gives the pricing model of this option contract. Now, what is this binomial option pricing model? Let us have a look on that. The simplest method that is for the pricing of this option is this binomial option, and in this options is using the binomial option pricing model, and this model uses the assumption of perfectly efficient markets. So, this is what the binomial option pricing model is doing, that it is assuming that the market have perfectly efficiency, or we can say that it is a perfectly efficient market. In that, this binomial option model is been executed. So, under this assumption of perfectly efficient market, the model can price the option at each point of a specified time frame. And under the binomial model, we consider that the price of the underlying asset will either go up or down in the period. So, when there is a perfect efficient market, what we are assuming that whether the underlying assets price will go up or will go down, that is what assuming in this binomial option theory. So, given the possible prices of the underlying asset and the strike price of an option, we can calculate the payoff of the option under these scenarios. So, whether the price will go up or the price will go down, according to we are going to calculate the payoff and then discount these payoffs and find the value of that option as of today or as of the executing day. So, that is what the binomial option model is. So, we have two period binomial tree here which can clear you up. So, this is a period 1 and period 2. We can see that these could be the two period binomial trees as it is seen here. Now, there are several options pricing models that use these parameters to determine the fair market value of an option, and the fair market value is the price an asset would sell or on the open market when a certain conditions are met. That is what the fair market value is, and the conditions that are there could be the parties involved are aware of all the facts, are acting in their own interest, are free of any pressure to buy or sell, and have ample time to make the decisions. This could be the conditions. So, of these, the Black-Scholes model is the most widely known one. So, that is what one of the pricing model of the option, and when there is these conditions are applicable, the most widely known model of pricing is the Black-Scholes model. So, what is this Black-Scholes model? Let us have a look. That this Black-Scholes is a pricing model used to determine the fair price of theoretical value of a call or a put option based on 6 variables. So, there are 6 variables on the basis of which this pricing model is being done. So, the main variables used in this Black-Scholes model, if we see, they are the price of the underlying asset, that is a current market price of the asset, what is the current price of this underlying asset on which we are taking the option contract. This is one of the variable. Second is the strike price, that is the price at which an option can be exercised, that is another variable. Next is the volatility. It is the measure of how much the security price will move in the subsequent periods. That is, the volatility is the trickiest input in the option pricing model, as the historical volatility is not the most reliable input for this model. So, this is what we know is an important variable, or we can say that it is an important factor when we are talking of option, or we are talking of any investment or any derivative or underlying asset. The volatility of the asset is the most important thing, and that is one of the variables when we are talking of the Black-Scholes model. Then another variable or another factor on which it is based is the time until the expiration. So, that is the time between the calculation and an options exercised it. So, in between what is the time, that is also the variable that we are considering while pricing the option in this Black-Scholes model. Apart from that, we have interest rate, which is the risk-free interest rate we are saying, and the dividend yield on that. That means that was not originally the main input into the model. The original Black-Scholes model was developed for pricing options on non-paying dividend stocks, but later on this dividend is included in the Black-Scholes model. So, this Black-Scholes model is a more widely known or mostly used model for pricing option. In Black-Scholes model, there are 5 variables that are being used from the beginning, that are the price of the underlying asset. As we know, that is most important and significant thing whenever we are talking of any derivative, and in option pricing also this price of the underlying asset is most important. So, this variable is included in the Black-Scholes model. Apart from that, the second important variable on which the Black-Scholes is based is the strike price, that is the price on which we are going to take the contract. That is important. Apart from that, what is important and considered in the Black-Scholes model is the time, that is the time of taking the contract and the time of exercising or the expiry date. That means the time period of holding the contract, that is important and is considered while we are pricing the option in this Black-Scholes model. Next important basis on which this Black-Scholes is done is the volatility. That means the variability or the fluctuation that is there in the price of the underlying asset. And this volatility is the most crucial and important thing while we are considering for the pricing of the option. There the price of the underlying asset will go up or down, or what is the degree of fluctuation that will be there in this underlying asset. That is very important, and that is one of the base on which this Black-Scholes model is being considered. The other important variable that is considered is the risk-free interest that will be there in that underlying asset on which we are taking or holding the option. So these are the 5 variables, or these are the 5 factors on which the Black-Scholes model was considered to be priced. But in recent years, there is another factors which is added and make it a 6 variable model, or the Black-Scholes is considering this 6 variable, and the addition to the 5 variable is the dividend yield. That is the additional variable that is added to the Black-Scholes model along with these 5 variables. This dividend that will be yield is an important thing to be considered while we are pricing this option. So these are the 6 variables which we are considering while we are pricing the option in this Black-Scholes model. Let's have a look of these 6 variable in a diagrammatic manner. Here you can see this is the option price. We are determining on the price of the underlying asset, the strike price, the time until the expiration or the time period, the volatility, the risk-free rate, and the dividend yield. And these 6 factors are the factors or the variables on which the option pricing is done in the model of Black-Scholes. Is constant for all maturities, that short selling of securities with the use of proceeds is permitted, and that there are no arbitrage opportunities without risk. So Black-Scholes pricing model is largely used by option traders who buy options that are priced under the formula calculated value, and sell options that are priced higher than the Black-Scholes calculated value. So what is this log normal distribution? Let's have a look on that. Suppose we have a random variable x. So this variable will have a log normal distribution. If it's a natural log, that is ln x, log x is normally distributed. So in other words, we can say that when the natural logarithm of a random variable is normally distributed, then the variable itself will have a log normal distribution. That is, if x is distributed log normally with the parameters mu and theta, we can write this as the formula. X is 10 to log n, mu and theta to the power 2. So the 2 most important characteristics of the log normal distribution are that it has a lower bound of 0, that is a log normal variable cannot take on negative values, and the distribution is skewed to the right, that is it has a long right tail. So these are the 2 important characteristics of log normal distribution. You can see the image here. These are the graphs of the log normal and normal distribution. Now, the Black-Scholes assumes that the options being priced are European style, executable only at maturity, and the model does not take into account the execution of American style options, which can be exercised at any time period and including the day of expiration. So, however, for practical purposes, this is one of the most highly regarded pricing models, and on the other hand, the binomial or trinomial even models can handle both styles of options because it can check for the options value at every point in time during its life. So, in today's class, we learned that the option contract that we have talked of, the most interesting type of derivative or financial derivative that we are discussing, whether it is a call option or a put option, how to price that, and what are the theories of pricing these option contracts. And we come to know that there are various models which are considered for the pricing of these option contracts. And in these various pricing theories or various pricing models, we discussed about the binomial method of calculating the price or binomial method of pricing the option, and we have a look on the Black-Scholes model of calculating the option price. So, these two are the most commonly and well known pricing methods of the option prices. And in binomial, we are considering that it is perfectly competition market, and accordingly we are doing the calculation, and we are considering that whether the market price will go up or go down, and accordingly we have binomial trees for the calculation or predicting of the pricing of the options. And in Black-Scholes model, we are considering or we are taking various variables, and accordingly we are calculating the pricing of the option, and in that we consider the important bases or important variables that are there in options. So, that might be the time period of the execution or the exercising of the contract. It is the free interest, it is the volatility, or it is the strike price. And in addition to that, what nowadays we are considering is the dividend yield on this underlying assets price. So, these are the 6 variables that we are considering while we are calculating the pricing of the option in the Black-Scholes model of pricing. And also we come to know on the log normal distribution that is important while we are calculating the price in the Black-Scholes model. So, in today's class, we had a wide knowledge on the pricing and the models of pricing of this option contract. In our further classes, we will go in detail and discuss more about this financial derivatives. For today, this is all. Thank you.